as a seller, I can't be picky and choosy. I can't just say like, this thing would have sold 6 months ago for 540. So I want 540. I've got to realize the market we're living in, the fact that, there's hibernation amongst a lot of buyers. So the buyers that are out there making offers, they're going to get good deals.
All righty, folks, we are going to have a very important conversation about mortgage rates, and we are going to talk about how soon we will have mortgage rates at 4.5%. Yes, folks, if you're looking at mortgage rates today, they're roughly 6.6%. So I want to know how soon we will have 4.5% mortgage rates, because I think 4.5% unlocks the broken housing market. We go back to a normal housing market. The move-up buyer is back in force. So I don't know about you, Matt, but I would love to see an unbroken housing market. And I think 4.5% is the number. How soon do we get there?
Okay, before I go into that, because I'm excited, I'm going to share a chart, and I think that anybody who's a champion for lower interest rates and excited about it is going to like what this chart says from a historical basis on what happens to the 10-year after a Fed rate cut. But before we talk about that real quick, before we get to, lower interest rates and the frenzy that will cause in a low inventory environment, I want to remind people that this is the type of real estate environment you want, the one we have right now. Rates are up. The election's less than a month away. I'm scared. I press pause. That's what most buyers are saying. And the whole Warren Buffett, be greedy when others are fearful, be fearful when others are greedy. Be greedy right now, because I can promise you, Sacramento's not the only place, but I go to a real estate meeting like I go to yesterday, begging. Like they're pitching their listing. I got a 2-bedroom, 2-bath. It's beautiful. It's $525,000. Bring me an offer. That's what listing agents are saying. And that's the type of environment you want to operate in. So by no means am I saying wait till we get to 4.5% if you're an investor, if you're a buyer, but this is good news for people that maybe refinance a property they get a good deal on in Q4 of 2024, and they can refinance it to 4.5, or, other people that for whatever reason are buying in the future and lower interest rates will help accommodate that.
I agree with all of that. We're going to definitely show the chart, spend a lot of time talking about getting to 4.5%, but I just want to echo that. I've been doing this for 20 some odd years. I keep telling you that buyer's markets are very, very rare. Buyer's markets are when agents say, bring me an offer. Buyer's markets are when disrespectful offers happen. Buyer's markets are when you could structure creative financing, a first and a seller second. This is where you can create cash flow at 6.5%. And then, oh, by the way, in a year and a half, 2 years, when rates are 4.5, you could do a refi and just explode cash flow. Do not wait for 4.5%, because the market will be bananas with buyers and sellers, and you don't know what will happen. So
no doubt.
With
and
that caveat.
One last thing on that is what I've learned recently. I don't think I knew this before. I thought to myself, buyer's market, and that's a couple years. Seller's market, that's 4 years. We go in and out of buyer's markets.
Yeah, buyer's markets are very short. Very short.
Might be for the next 3 months.
Correct.
Could be 2 months, could be 6 months. We don't know, but there's no guarantee. It's not like, oh, we're in a buyer's market. This is where we're going to be for 2 years.
No, they're never 2 years. Buyer's markets are generally quarters. They're measured in quarters, 6-9 months. This will be over.
This chart, Mike?
Yeah, it'll be over in the spring, but let's take a look.
All right, here we go. So I think David Rosenberg is the economist who I think he's on Twitter, and he's well respected and liked.
I watch this stuff. Yep.
Barry Habib shared this chart this morning. He gave David the credit for it. And let me see, is that still up for you? Because I'm just putting it where I can see it.
Yep, I can see it.
Okay, cool. This is the Fed rate cut history going back to 84. So going back 40 years.
Okay.
From the first cut, the cycle of rate cutting, and what does the 10-year do? Anybody listening who's an ORaaT follower probably knows that the mortgage rates follow the 10-year treasury. The
plus the
average spread is probably 1.8 above it. If you want to take the 10-year and add 1.8, that's where interest rates on the 30-year fixed rate mortgage usually are. Currently, they're like 2.5. Even taking 2.5, Mike, this is like sub 5% mortgage rates. If we take 2.25, we're like at 4.5. And I'll show you the math behind it. because I thought it was pretty cool. And anybody who's hoping for lower mortgage rates will think it's pretty cool. And the funny part is this recent, like September 18th cut that led to a initial spike.
Mm-hmm.
That's happened 1, 2, 3, 4, 5, 6, 7, 8 of the last 9 times too, where initially it's gone up.
That's important because I had seen this in the data as well, right? The first rate cut starts a cycle, and the first move in the 10-year, as this chart shows, is usually up, but that does not last long, as you will see subsequently.
Right. Yeah. So 8 out of 9 times the 10-year goes up. This time it went from 3.7 to 4.06. That's why we went from the 6.1 we had on the 30-year rate up to a 6.6, you know, like, because we saw this initial spike in the 10-year, and 30-year follows the 10-year. But then through the rate cutting cycle, you can see the cycle high after that, you know, first cut, and the cycle low. And historically, what they did here is they looked at like 5.3%, but the 10-year was at 12, right? And then other years where the 10-year is at 8 and it goes down by 3%. So rather than take the average of what percent it declined, they said, let's take the relative percent decline, 43.9, 38, 33. And what would we expect? We'd expect on average, the average percent decline from this first cut is 37%. So you take a 37% cut from 3.7. That's where the 10-year treasury was when we first cut interest rates.
Yep.
And if we follow this trend, if we take the averages, the 10-year at the cycle low, whenever that is, 15, 18 months from now, is 2.35%, Mike. And
I just did the math. Yep.
Right. 2.35. We can add 2.5 to it. That the spread between the 10-year and the 30-year again, right, is like historically 1.8. At 1.8, we got 4.15% 30-year fixed rate. But let's say the spread never, you know, goes back to normal levels. It stays at 2% or it stays at 2.25. At 2%, we're 4.35. At 2.25, we're 4.6. Either way, we're talking mid fours on a 30-year fixed rate mortgage. That should excite people that mortgage rates could. And again,
you know what I would love to see on this chart, and if you could send it to me, I'll do the work. So if you send me this chart, I would love to learn the date of the cycle low, because the earlier question we started this video with is how long will it take for us to get to this 4.5% mortgage rate? So we have all the data here. I just need to go back to these rate cutting cycles and figure out what month we had the cycle low. So, you know, the first date, you know, so we cut September 20th, we spiked to 12.56 shortly thereafter. How long did it take for us to get to 6.95? Now, that could be a year, it could be 2. That's the one question I have. But I think
that's a good question. I'm going to see if I can dig it up. I'll send this to you, but I'm going to see if I could dig it up where, you know, was it 36 months before they got to the cycle low?
Yeah, we don't know. We don't know, because that's the important point here, because I think the pattern is repetitive. First pattern I see, and it's been validated, is the 10-year initially spikes, which again probably drives the average person bananas. The Fed cut 50. Why did the 10-year go up? Well, look at it last time. So in 87, the 10-year went up 0.37. In 2001, the 10-year went up 0.4. Right. So these all the times where there was a 50 basis point cut, it went up. So you're not sharing anymore. Whatever you did made it go away.
I moved it. And it was stuck between screens.
Yeah. So I don't see anything. But that's the idea. So there it is. So we've cut 50 4 or 5 times and we went up. So I think that pattern is clear. I think it is also clear that once the Fed starts cutting, it's a cycle. This is not a one and done. We all expect more. The argument is how fast and how many. So that pattern is legit. The one question you and I have to ask, and I think we could do this before next week, is how long from the first cut to the cycle low in mortgages? Because if we can get that average duration, then we could say with some, you know, some math, we think we could get to 4.5 in X amount of months. I think that'd be interesting.
Yeah, for sure. I'm gonna reach out to some of my friends at MBS Highway, because again, I got to give credit to Barry Habib and MBS Highway. He gave credit to David Rosenberg for putting the stuff together. But that was some news this morning that, quite honestly kind of surprised me.
Yeah, I think you're right. I would, if you would have asked me, just Mike, the last 10 times the Fed cut, how many times did the 10-year go up or down? Naturally, I would have guessed probably 6 times it went down and 4 times it went up initially. I would have
Right.
been wrong. It's 9-1.
Yeah. Yeah. It's
Yeah.
it's interesting stuff. And, a path to 4.5. I've told people, who knows? Who knows if we get below 5? Maybe we settle between 5 and 5.5. This shows, historical average and trends that, we could be at 4.5 in 24 months, which, like you said,
Maybe.
would unlock a
Maybe.
lot of move up buyer. It would unlock a lot of demand, and it would, in some ways, help fix a broken housing market
Yeah.
because we're,
Yeah. Let me say it this way: 4.5 unfreezes the housing market. But here's the rub: we won't just shoot to 4.5. In my opinion, what we will see over the next 12, 18, 24, 36 months is a slow grind lower. And we will eventually end up there, but you don't wait for that, right? You take advantage of the buyer's market. You create the deals that work today, and then you own assets. And then when bananas things happen later, you're an asset owner. You don't want to suddenly wake up and everything's 4.5%. Remember what that was like? That was crazy.
right. Yeah. Yeah. People have a short-term memory on what it was like in 2021, where it was wild, 24 offers and all contingencies removed. Find out
I
later
like
you got a
times like this
foundation.
much better.
Right.
I like it when selling agents are begging for offers. I suddenly get excited when I hear that.
Right. Yeah. No, trust me, it's a good time, and that's what I'm trying to remind people. It's a boo-hoo, rates are up, and I go, it's time. That's celebration. Your
It doesn't matter to
competition
me,
just
man.
went back to hibernation.
Exactly. Yeah. Again, I only write deals that make sense today, which means I write disrespectful offers. I get seller concessions. I get buy downs. I get sellers carrying seconds, silent seconds, no payment seconds. It's just write deals that work. And if the seller doesn't have any other options, they either A, take it off the market, or B, they have to negotiate with me. I'm okay either way.
Yeah. You know what's funny? Mike? This is a real life scenario, and I think it's funny being on this side. I've got a fourplex that served me well, but it's got a ton of equity, and I'm just extracting that equity by selling it and repositioning that in something different, closer to me, a different type of asset. So I'm on the sell side. I've got a fourplex that I promise in a different time would have sold like this at 540. And I'm at 495. People are throwing 456 at me. I applaud
Yes.
the buyer that came back 2 weeks later and saying, hey, 456,
I'm still here.
what you think? And all of a sudden I'm like, well, if we go to 475 and you don't take a buyer's commission because you're an agent, it's an agent on the buy side. Maybe we meet in the
get
middle.
there.
And
yeah,
I understand the market. And so I've got to live it too, right? As a seller, I can't be picky and choosy. I can't just say like this thing would have sold 6 months ago for 540, so I want 540. I've got to realize the market we're living in, the fact that, there's hibernation amongst a lot of buyers. So the buyers that are out there making offers, they're going to get good deals on my listing included, right? Unless, I decide to pull it off because I don't really have to sell it.
Right.
So
that's the idea. Sellers in this environment, when they got a guy like me who's following up every 2 weeks, you're going to either A, take it off the market, or B, you're going to negotiate with me because I'm the only guy at the dance. You don't have another option.
Right. Yeah. And sometimes,
that's a good place.
Sometimes a seller like me, who's reasonable person, says, you know what? It's 25,000 less than I thought my bottom was, but I still like what I want to do still makes sense. Take money from here and go there. This thing
you have a choice
in value over the last 5 years. So, knowing that I'm giving it away, knowing that I'm giving somebody a great deal, that's the market we're in. They're right when they come back.
Buyer's markets, baby.
Say, it's me or nobody.
That's right. Matt, if somebody want to reach out to you, get qualified, because again, you got to be ready to be ready. How can people reach out?
Go to greatmortgagebroker.com. Fill out the quick form. We're in 48 states. More than happy to help. If you want to email me directly, you can gamble and do that. Matt@mtmg.com. It might get lost. I'm going to warn you in advance. Send it to me twice if you need to. Matt@mtmg.com. or fill out the quick form at greatmortgagebroker.com.
Awesome. Thank you so